So in the last video we discussed about the double entry to record provision for depreciation and the T accounts of provision for depreciation and non-current asset account, right. In this video we will be solving a question in which we will be required to do the same, so that you get a good understanding that how do we go about such questions. Okay, so let's begin. The question says a company maintains its non-current assets at cost, right. So there is a separate account maintained for non-current assets and a separate account is maintained to record depreciation on those non-current assets. Very good. Information related to its fixtures is as follows, right. So we have the information related to its fixtures. Now there are 2 years mentioned in this question. First year is 2016. The company is purchasing an asset that is fixtures for 290 at what date? At 1st January in 2016, and in the same year on 1st of July new fixtures being bought at a price of 620. Okay, so 2 assets, 2 fixtures are being purchased in 2016. Then what is happening in 2017? On 1st of December, again fixtures are being purchased for 130, right. So we know that the purchase of fixtures is recorded in which account? In the assets, of course, in the assets cost account. So that would be the fixtures account. We will be recording these transactions. Now the question also says that these are to be depreciated at 5% per annum using the reducing balance method. Very good. So we have the method reducing balance and we have the percentage rate as well. Now we just have to find out that whether we are following the full year policy or the monthly basis policy. So it says that the depreciation is to be calculated on assets in existence at the end of each year, giving a full year's depreciation even though, right, even though the asset was bought part of the way through the year. So this means that which policy is this? The question is saying that you have to charge depreciation no matter what the purchase date of that asset is. So you have to charge full year depreciation in the year of purchase. Full year means you don't have to count the months and then calculate the depreciation. So in this policy, does the purchase date matter so much? No, because no matter, even if it is being purchased just 1 month before the year end, we have to charge full year depreciation in the year of purchase, right. So we know the policy, we know the method and we know the percentage rate as well. Now let's see what the requirements are. Part A says you have to prepare the fixtures account. Secondly, you have to prepare the provision for depreciation of fixtures account, and lastly the statement of financial position extract as at 31st of December 2016 and 31st December 2017, right. So SOFP extract means I'll be showing you that. This means that at what value will you show your fixtures in your statement of financial position. And with this requirement we also know that what the year end is, and that is 31st of December, right. So we have to show this information for 2 years, 2016 and 2017, right. So let's begin. First we will be constructing the fixtures account at cost and then the provision for depreciation of fixtures account, right. Let me just give you a recap of the T account and the double entries that we studied in the last video. Non-current asset cost account is maintained like this: brought down and the purchases on the debit side, carried down on the credit side. And for provision for depreciation, the opposite of the cost account, brought down and the current year income statement figure, that is the current year depreciation on the credit side, and balance carried down, that is the accumulated depreciation on the debit side, right. And what is the double entry to record provision for depreciation? Income statement debit and provision for depreciation credited with current year depreciation only, right. So keeping this in mind, let's start with the solution. So the first year is year 2016, right. There is no brought down given, so no brought down. We will just start with the purchases. In 2016 on 1st January the business is purchasing fixtures at a price of 290. So 2016 both sides. January 1st, let's assume that this asset is being purchased through cash, right. So cash account will be credited and your fixtures account, non-current asset account, will be debited with 290, right. Now in the same year, in July, I guess on July 1st, yes, on July 1st again fixtures are being purchased for 620. So let's assume again it is being purchased through cash. Now is there any more purchase in the same year? No, right. So that's it. That's how you maintain a cost account. We do not record the provision for depreciation in the same account, no, right. We just record the brought downs and the purchases of the assets in the cost account. Now we'll just balance it. So the total of 290 and 620 would be 910. The total will be written on both the sides, debit and credit, and the same figure will be the balance carried down figure as well at 31st December 2016. This is how you maintain a cost account. Now, we are moving in the next year, that is year 2017. On January 1st, that is the first date of the new financial year, we will first write the brought down now. Balance brought down coming from the last year amounting to 910. Now, we will record the purchases in the next year 2017, and this purchase took place on 1st of December at 130 price. So, December 1st purchases 130. So, no other transaction, we will again just total it. 910 plus 130 would be 1040 on both the sides, and the same figure will also become the balance CD figure for year 2017 on December 31st. Right, this is how you make a non-current asset cost account. One last thing that you should also do always and for any T account, that is to bring down the balance for the next year. So, let us write that down as well. For 2018 on January 1st, the balance brought down would be 1040. Now, the T account is complete, right, after the balance brought down for the next year as well. Now, let us move towards the provision for depreciation account for fixtures. Again, do we have any balance brought down? No. So, in the first year is year 2016, both sides. First entry, right? First entry is usually the balance brought down, but since it is not given, or suppose this is the first year of the business, so there will be no balance brought down. So, the next entry would be to charge depreciation on the non-current assets in the current year, and that entry will appear on the debit or on the credit side? On the credit side, because that will be increasing its balance. So, contra asset account, increase in balance will be recorded on the credit side at the last date, 31st of December, and that would be the income statement figure, right? Okay, so now let us start with the calculations, right? I have a working area over here. What you need to do now is that since you will be following the reducing balance method, so let us just stick to the vertical format of calculating depreciation. In this question, we have 3 assets, right? Fixtures 1, fixtures 2 and fixtures number 3. So, in the first year, that is 2016, I am purchasing an asset that is fixtures 1, and what is the cost of that asset? Let us check that from the T account. It is 290, right? So, the cost is 290, and now I have to charge depreciation. The rate was 5%, right? 5% on this 290. So, the value would be 14.5. So, but let us just round it off to 15. We will calculate the net book value in the end for both the assets. Now, fixtures 2 are also being purchased in the same year, right, at the price of 620, I guess. Yes, 620. So, let us charge depreciation on that as well. Cost now written on in the second column, 620. Depreciation again at the rate of 5% on the cost of the non-current asset. So, that would be 31. Now, let us calculate the net book values for both of these assets. 290 less 15 would be 275, and for fixtures number 2, it is 589. Right, this is the net book value at the end of year 2016. Now, what is the required value that will be recorded in the provision for depreciation account? These values, 15 and 31. Right, because this is the current year depreciation, the depreciation related to 2016. So, what I will do, I will add these two figures, 15 plus 31, and that would be 46. So, the accumulated figure will be written in the provision for depreciation account. So, the income statement will be debited with 46 and provision for depreciation will be credited with the same value, and that is 46. Right. So, what will be the double entry? For year 2016, the double entry is income statement debit 46, current year depreciation, and provision for depreciation credit with 46. Now, is that it? No. I know I have to balance this account as well, and the balancing figure would be on the next side, that is on the debit side. December 31st, and that is the balance carried down, your accumulated depreciation for the year ended 31st of December 2016, and in this case this is same as the income statement figure, right? So 46 done with year number 1. Now let's move to year number 2, and that is 2017. Now in this case, now we have the balance brought down. So first we'll write that January 1st balance brought down 46, right? Next entry will be to record the current year depreciation in the income statement, of course. So income statement will be debited and your provision for depreciation will be credited. So now in year number 2, that is year 2017, in the next year, right? Now first let's just charge depreciation on the previous assets, that is fixtures 1 and fixture number 2, because we know that we are purchasing another asset in the in year 2017, right, amounting to 130. So first let's charge depreciation on the previous ones. So fixtures 1, right, depreciation will now be on the net book value, right, not on the cost, because we are following the reducing balance method. So 275 multiplied by 5% would give me a figure of 13.75. let's just make it 14. Now for fixtures number 2, depreciation will be charged on the net book value. 589 multiplied by 5% would be 29.45. let's just keep it till 29. And now lastly fixtures number 3, right, the cost of this asset is how much? 130 in the last column, right, third column for fixtures number 3. Depreciation would be on the cost, right, 130 multiplied by 5% would be 6.5. So let's just round it off to 7, right. So now we have the current year depreciations for all of these assets. Let's calculate the net book values as well. So for fixtures 1 it is 275 minus 14, 261. For fixture 2 it is 589 less 29, it is 560. And for fixture number 3, 130 minus 7 would be 123. This is the net book value. That is what is the actual value of these assets after being used for first 2 assets for 2 years and last asset for first year. These are the net book values. Now which amount should I take in my provision for depreciation? The net book values, or the sum accumulated depreciations, or the current year depreciations only? The current year depreciation will be recorded in the income statement. So 14 plus 29 plus 7, these 3 depreciations for the 2 assets that were purchased in the last year and the third one being purchased in the current year. So 14 plus 29 plus 7, the accumulated depreciation on these 3 assets in for the current year only will be recorded as a credit entry in my provision for depreciation account, and that is, so how much will be recorded as a credit entry in my provision for depreciation account? The net book at the net book values, or the sum accumulated depreciations, or the current year depreciation only? So the current year depreciation calculated on the net book values of these 3 non-current assets will be recorded as a credit entry in the provision for depreciation account, right, and that would be 14 plus 29 plus 7, right, and the figure would be then 50. $50 will be charged as depreciation for the current year on 2 assets that were being purchased in the last year and the third one being purchased in the current year. So now let's just record that 50 being recorded as a credit entry. The double entry would be for 2017. Income statement will now be debited with $50 and provision for depreciation credited with $50. Right now, one last thing that we have to do is to balance this account. So December 31st balance carried down figure would be now 46 plus 50. We know that this is the accumulated depreciation being charged in the statement of financial position. So $96 will be recorded as a balance CD figure. Lastly, what we also have to do is bring down the balance for the next accounting period. 2018 January 1st balance brought down is now 96, right. So this is how you prepare a provision for depreciation account for any non-current asset. the income statement figure, current year depreciation being credited, and then as balance CD will be extracted to be carried down as a balance brought down for the next accounting period. Then for the next period, balance brought down and the current year income statement will be added, so that we have the balance CD figure. Now we are done with the first two requirements of this question, that was to construct the fixtures account and the provision for depreciation account. Now we are just left with the SOFP extracts for these 2 years. Okay, so SOFP extract, right? So first year is 2016. Let's give a heading of non-current assets first, non-current assets, and the name of the asset is fixtures in this question, right? So fixtures, the total cost of fixtures in 2016 is how much? Now you just have to go to your T account to find the answer. You don't have to go to the question again to calculate these two figures. So the balance CD figure, we'll just look at the balances carried downs figure for a statement of financial positions extract, right? Just look at the for SOFP extracts, just look at the balance carried downs figure. So the balances of assets and liabilities and capital at that date are to be recorded in the statement of financial position, right? The other name for statement of financial position is balance sheet. So that is why its name is balance sheet, because now we look at the balances carried downs figures only in order to prepare our statement of financial position. So the balance CD figure in 2016 in the fixtures cost account is 910. So we'll write this value as it is. 910 is the value of my fixtures in year 2016. Now this was at cost. Now since depreciation is a reduction in the value of non-current assets, I now have to subtract the provision for depreciation for this year. So less provision for depreciation on fixtures. And what is that value? Again, you just have to look at the balance CD figure for this year. So balance CD is 46, right? In this question there was no brought down, so only the current year depreciation will be recorded as the accumulated depreciation. So that is 46, right? So what is the net book value? 910 minus 46 is 864, right? So this is the net book value of these two assets in the year 2016, right? Now let's move to the next year, 2017. Again the same format, let's write that down. Now the cost of fixtures is again the balance CD figure 1040, right? Because we purchased new asset in 2017, so the accumulated figure is now 1040 at cost, and the accumulated depreciation in 2017 is how much? 96 on these three assets. Please make sure that you don't subtract the income statement figure in the statement of financial position, because that is the figure for current year depreciation only. In statement of financial position, the accumulated depreciation is subtracted from the cost of the assets, right? So from the time the asset was purchased till today's date, how much it has been depreciated, that value is taken into account when we are preparing the SOFP extract or the statement of financial position in total, right? So the cost is 1040 and the depreciation accumulated is 96. So 1040 less 96 will give me a value of 944 as my net book value for the year ended 2017, right? So this is very simple. You just have to remember, it's all logical as well. You just have to remember that what value is subtracted in the statement of financial position, that is the balance CD figure, the accumulated depreciation at year end, right? And what value is credited in the income, in the provision for depreciation account against income statement, this value is only the current year depreciation. If you remember this format, if you remember the logic behind these double entries, it will be very easy for you to solve any sort of depreciation question, right? So that's it for this video. In the next video, we'll be solving again an example, but that would be a little bit complex example, so that you get an idea that how do you go about such questions as well. So see you in the next video.